What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about one software stock that I haven't really discussed ever, I think, on the channel. Maybe there's one video out there that I've done on this stock, but this is a company that has consistently grown revenues. It's a very high quality SaaS company that basically works with governments, right? So it's very much geared towards public agencies, government agencies, and they provide their software to these government agencies. So they have a lot of contracts and recurring revenue of over 90% that's been grown over the last 10 years. So we're going to talk a little bit about it. The only concerning factor, there's actually two of them, which are going to be the valuation and the balance sheet, which I'll talk about later in the video. But as always, if you enjoyed, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buying alerts, options alerts, trade ideas. I did open up a couple more spots if you're interested in joining, and accessing members only private videos and the intrinsic value spreadsheets as well. So links are going to be down below. So this right here is the company that we are talking about today, and the name of the company is Tyler Technologies, ticker symbol TYL. And it is a leading provider of integrated software and technology services to the public sector, and the solutions empower local, state, and federal government entities to operate efficiently and transparently with residents and with each other. So they've got a lot of different types of software and services that they offer to the public sector functions, including the appraisal and tax. Tyler provides software solutions for managing all aspects of the property tax life cycle, from appraisal to billing to collections. Civic services, they also provide service solutions to help government agencies streamline and automate a variety of citizen-facing services such as permitting, licensing, and utility billing. We've got ERP, so that's going to be enterprise reduced resource planning solutions. We got land and official records. We got outdoor recreation. What's wrong with me? We got regulatory. We got courts and public safety. We got health and human services, and we got K-12 education services as well. So they work with government agencies. They've been able to grow their total addressable market over the years. And this is straight from their August 2023 investor presentation, where they have, once again, $1.85 billion in 2022 revenue, and over 80% of that is coming from recurring revenues, right? So software as a service, so recurring revenue, and that has been up from 55% in 2010. So that just goes to show how consistently not only have they grown revenue, but a composition of that revenue has also gone towards recurring revenue, and their licensing and maintenance revenue has significantly gone down, which is only a good thing because it's a very sticky business model. It's a company that you can rely on for the long term, because government agencies, once they are stuck, or not really stuck, once they are familiar with the software, they're going to want to use it for a very long time. So that's what Tyler Technologies basically offers. And this is their total addressable market, which local and education at the time in 2018 was about $16 billion. And in 2023, they got state, local, and education software market at $34 billion, and federal software market at $42 billion plus is going to be that market. And right now they're only $2 billion in that addressable market today. So they've got lots of opportunities to keep growing, and 7 to 9% is going to be that market growth for the company. Now, 17 acquisitions in the last 5 years is what they have done. So all these acquisitions for all these different companies that have advantages are expanding total addressable market. So these are significant benefits of these acquisitions: adding new products and technologies and capabilities, adding clients, and leveraging our sales organization and client base as well. And these are some of the sustained value additions or creations from the company: prudent capital allocation, which I'll go over in just a minute; strong free cash flow. That's true. They have been able to grow free cash flows very well; margin expansion; and organic revenue growth for the company as well. This right here is going to be their 2030 targets. Okay, 2030, they're expecting revenue to be about $3.6 to $3.8 billion. In 2025, they're expecting $2.3 to $2.5 billion. And recurring revenue is going to make up over 90% by 2030 is what they're hoping for. Gross margins are going to expand to over 53 to 55%. With operating margins at 30% plus, and free cash flow margins of in the high 20s. So 27, 28, 29% is what they are expecting for free cash flow margins, and operating margins over 30%. Now, capital allocation priorities going forward. Now, they do have a little bit of net debt. So their main priority, number one, is pay down debt, which is good, right? You want to hear that from a company. They are going to be using capital in a way to pay down debt. That's really good. They're going to focusing on strategic acquisitions as well. They're going to be focusing on more of these and opportunistic share repurchases as well. So share buybacks, they haven't really issued a lot of share buybacks ever. They've been slowly and steadily kind of increasing the number of shares outstanding. But these right there are the three main priorities for the company, which should be the main three priorities for any company out there: to reduce the number of debt, to do very strategic acquisitions so they can grow their TAM, grow their products, grow their revenue, and also do share buybacks so they're not diluting shareholders, which is very strong, very good. 2030 goals, again, aligned with executive compensation, so 30% plus margin expansion and operating margins, free cash flow margins in the high 20s, and approximately $1 billion in 2030 free cash flow is what they are expecting, and 10 to 12% in organic recurring revenue growth, and over 90% of that is going to be recurring revenue growth of revenues of $3.6 to $3.8 billion. Now, moving forward, second quarter 23 numbers. Again, this I don't consider Tyler Technologies to be a growth stock, because even if you come over to our spreadsheet, you'll notice that the expected earnings are a little bit over 16%. So I guess there is some element of growth here, and this is going to be the actual chart, which we'll get to in just a minute. And you can see very, very strong, consistent growth since 2000. The stock price is up a whopping 40,000%. So absolutely insane growth here, no doubt. The volume is pretty low, right? So that's why I consider this to be a little bit of an underrated stock, because not a lot of people are talking about this company. 172,000 shares traded every single day, right? So it's a really low volume stock. Now, 16%, I guess, is modest growth, but it's not like a high growth company. And free cash flows have also grown by 22 to 35%. And they're expected to grow at over 18% if they are to hit their target of $1 billion, right? But of course, second quarter numbers were a modest growth of about 7.6, 6.9, 5.4% in EBITDA. So overall, very reasonable growth here. And this is right now the guidance for revenues between 1.94 to 1.96 billion and $7.60 to $7.75. So if you take into account the price at which Tyler Technologies trades right now, $381. So 381 divided by 775, we're looking at a 49 times price to earnings multiple, right? 49 times PE multiple is a significant premium, right? In terms of its valuation for a growth of just under 12%, right? So 750 growing that to 775, it's not really that much growth. 775 divided by 750, we're looking at a growth rate of actually a little bit under 4%. 3.3% is going to be that growth for the company. You just want to make sure that that is indeed correct. 7.5 times 1.03, and that is going to be 774.75, right? 775 pretty much. Yeah, so 3.3%, right? So 49 times P multiple for 3% growth. Yeah. This is a dislocation here. This is significant dislocation, but not to mention, revenue growth has been very strong, consistently growing from 416 million to over 1.9 billion dollars and 193 million dollars in gross profit, growing that to 821 million, and operating income's also gone from 67.1 million to 211 million dollars. So very, very nice, consistent growth. You can see the graphs here. Every single year, they've been able to grow the revenues, grow the earnings, grow the margins, grow the operating income. Net income's also gone from 40 million to 164 million, and EBITDA also moving in the right direction from just under $80 million to $317 million. Shares outstanding have also increased every single year by about 2%, and free cash flow has gone from $40 million to $315 million. So the fundamentals are phenomenal, right? Revenue, earnings, margins, free cash flow, EBITDA, everything's moving in the right direction. There's a few different things that do concern me. Number one, the balance sheet, $137 million of cash and debt sitting at almost $1 billion. So they do have a net debt of $787 million. So that's problem number one, right? And debt to free cash flow also a little bit under 6. We look for this number under 3, so that's definitely very high. Margins are good, right? So we've got good gross margins, good net margins. That is going to improve and get better over time by 2030 as what they have kind of envisioned for the next 5 to 10 years. And we got pretty low return on common equity, assets, and capital, but that is only, in my opinion, going to get better as margins improve and recurring capital, recurring revenue also increases. But the problem number one is the balance sheet. Problem number two is the valuation, as we've already gone over. Very, very high multiples. Price to sales trading at over 8. Price to earnings trading at over 49 to 50. Price to cash flow trading at over 39 to 50. Again, just really, really high multiples. And this is going to be that earnings forecast from $7.68 to over $29 by the year 2032. So if you plug in those numbers, we're looking at a 16% growth rate. Free cash flow is growing by 22 to 35%. And shares outstanding have gone up by 2%. This is problem number 3. So everything is excellent. Growing TAM, growing fundamentals, growing revenues, margins, profitability, free cash flow, EBITDA. But 3 concerns I mentioned: balance sheet, more debt than cash on the balance sheet. We've got valuation, trades at a very, very expensive valuation. And number 3 is the share dilution. 2% every single year is what we have seen from the company, which obviously is a bit too much. So if this is what I've basically penciled in, 18% growth rate in net income, 20 times P multiples. So a lot of that, sell off, a lot of that fair value discount is going to come at the expense of multiple compression. So 20 times coming from 50. Free cash flow growth rate of 20% is what I've priced in. And that's going to put us on the target for $1 billion by 2030. 20 times free cash flow multiple, 12% discount rate because the company does not pay any dividends. Margin of safety of 10%. They did mention share buybacks in their slides, so I'm going to give them the benefit of the doubt and do negative 1%. 50% weighting to the EPS, 50% to free cash flow, and we get to a fair value of $193. And right now it's trading at $381, so that's about 49%. And you'll notice a lot of that is coming from the fact that it's trading at a high multiple, right? So if I go with 40 times for both price to earnings and price to cash flow, and now we're sitting at $387, almost identical exactly to where the price is, only 1.67% undervalued, right? So it's most of that intrinsic value discount for 49% is coming at the expense of the valuation. And that's really what we have to look for because, again, it's gone up over 40,000%. It's always traded at a premium. Right now, it is down from its all-time highs. So all-time highs sit at well over $560. At one point, it was down 50%. Right now, it's still down over 33%. So I like the company. It's a phenomenal company. It's got recurring revenues coming in from government agencies, from the public sector, but expensive valuation. So $303 is going to be that next support right now. That's exactly where we were back in March and April of 2023. And resistance right now, 426. That's exactly where we got rejected, similar to what we got rejected back in August of 22. And we got rejected there in July of 23 as well. And support level is going to stay put at $303 all the way down to 249, 250. So this right here would be the next level of support in case we break down below $300. And I could see myself at least getting a bit of a starter position in the 250s for Tyler Technologies. So let me know your thoughts down in the comment section below. And what do you think about this company? And, have you looked into this? Again, it's definitely got a low volume. So that's also something to keep in mind. And I don't expect a lot of people to know about this company because the volume's so low. But next support is going to be $303 and resistance at 427 with my fair value sitting roughly at 193. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas. So link's going to be down below. As always, happy investing. I'll see you all in the next video.